Hello everyone, this is Carbonomics. I'm going to highlight how both investors in ESG related stocks and oil and gas investors can both benefit from the mania we have previously seen in ESG and will likely see again. And while many oil and gas investors have been assuming ESG would be dead by now, there's still generally an influx of capital into ESG funds even now. So you can profit from being on either side of the trade, take your pick. Fight with the agenda of governments in the Western world or against them, and I have a feeling it'll work out for you either way. But if you really want to make out like a bandit, you can take positions in both sides of the coin as I have. I currently hold stocks in my portfolio that are both entirely ESG oriented and others that are oil and gas producers, although I do focus on ESG oriented stocks on this channel. If you manage to time it correctly, you can start to transition out of the oil and gas plays and into more green assets as ESG comes into favor again. But as I always discuss why investing in ESG is a great long-term investment on this channel, let's start with the reasoning why fossil fuels will actually benefit from ESG. Shouldn't these companies be hurting as we move away from, CO2 emitting commodities to more environmentally friendly sources of power and energy? Wouldn't this mean that owning stocks like oil or gas companies would be a bad idea? That's what you might be asking. Well, I want you to think about some of the basics around supply and demand of commodities like oil and gas. What's really the basis for these commodities to continue their usage at relatively low costs? That'd be exploration. And we haven't done nearly enough exploration to find assets that could be developed to bring oil prices down. In 2021, oil and gas spending on exploration was 28% below average spending over the 5 years before the pandemic. We have seen the Western world begging international leaders in the oil industry and OPEC, like Saudi Arabia, for more oil production. But even now, Saudi Arabia doesn't have the spare capacity to bring online. Why is this happening? Well, for one part, ESG has made it difficult for oil and gas companies to feel comfortable expanding their capital expenditures, at least in the Western world. These companies don't want to spend hundreds of millions or billions on assets that will be considered dead weight in 10 years, and they'll have to write it off on their balance sheet. No one in the United States would even dare to consider the idea of opening up a new coal mine. The EPA is currently in the process of placing even more limits on pollutants like coal ash from power plants to essentially encourage the entire industry in the U.S. to transition away from coal. Now, as I say this, the price of thermal coal, which is used in electricity generation, is up to $400 per ton in Newcastle, up 8x from the 2020 lows. So let's summarize this, right? Renewables are being subsidized to an extreme degree, making it difficult for fossil fuels to compete. Public opinion is against them. Governments are against them. Current producers are not spending money on new sources of supply, and instead they're returning capital to shareholders through dividends and buybacks. And regulations or guidelines surrounding ESG are making it a challenge for new sources of funding to enter the space and fund fossil fuel projects. At the end of the day, all this really benefits the current producers of fossil fuels, especially outside of the Western world in developing countries like Russia, China, Indonesia, and others. The places that don't have insane governments pushing some of the mandates that we're seeing. All these forces are working against new competitors and suppliers entering the space. So the incumbent producers of fossil fuels will only make even more profits. It will also take even longer for prices to come down and supply to finally come online. As all commodities are cyclical, this bull market will eventually end at some point, but it really is unknown when that will be. Ultimately, cutting off capital to new projects for ESG will help reduce emissions to some degree, but it will also make Europe and the United States even more dependent on potentially hostile nations for sourcing commodities. This outsources the problem to the third world, and it essentially doesn't stop the extraction of fossil fuels from occurring at the end of the day. So there are plenty of opportunities out there for you to benefit from this anger towards fossil fuels if you're interested in that. But moving on to the other side of that coin, there are obvious reasons to be interested in ESG related companies, renewable energy developers, carbon credit companies, plastic recyclers, and other green ideas. The government in Europe and North America, or the varying governments, are essentially spelling it out for us. They're actively incentivizing the development of these projects, especially in the recent Inflation Reduction Act that was passed in the United States, which was essentially pulled out of the Green New Deal, and the Fit for 55 deal in the European Union. These deals contain tens of billions of subsidies for green energy sources. And this really isn't even mentioning the forces for ESG we've seen sweep across the financial markets, outside of government intervention. Interestingly enough, the capital flows into ESG funds have been surprisingly positive most of the time over the last few months, even given the increasingly obvious energy crisis emerging here. Large asset and fund managers like BlackRock are requiring companies in their portfolio to have net zero commitments by 2030. Another interesting point, a third of global assets under management, or $53 trillion, are expected to be invested in ESG-related assets by 2025, according to analysis from Bloomberg Intelligence. If this is even remotely true, then there are trillions of dollars waiting to be invested in ESG assets right now. And many of these stocks that I invest in personally are microcaps, meaning there's incredible upside as these funds actually can't even invest in these companies yet. Specifically, carbon credit companies like Base Carbon have to grow and list on even larger exchanges like the NASDAQ for institutions to even be interested in these companies, because they're simply too small right now. This provides a natural runway for share price appreciation for smart retail like ourselves. You decide to take that route. At some point here in the Western world, if a company wants to receive funding through debt, they'll essentially be forced to embrace ESG-related goals to do so. And if they decide not to, then their competitors will. So there are many different factors here that point towards a world where ESG's popularity continues to grow. And like many cyclical trends, ESG and climate awareness fall in and out of the public eye from time to time. And we've continuously seen it throughout the last 10 to 20 years here especially. But the larger trend is that ESG always enters the public's consciousness again. And every time it does, it has an even bigger impact than it did the last time. And I believe that ESG will return, and both governments and the financial markets will celebrate it when it happens. Hell, it might even manage to sustain itself right now. But time will tell. Both fossil fuel investors and ESG investors will eventually benefit from this inevitably. And it really is up for you to decide which trade you'll take, or if you're even interested at all for that matter. But yeah, this is the end of the video. If you liked it, please remember to like, comment, and subscribe for the YouTube algorithm. Always helps out. And thanks for watching. And I'll see you in the next video I post on the weekly carbon news on Sunday at 6 p.m. Eastern Standard Time.